for providing the money. They're not giving away money just because they don't like money anymore. So the usual aim for the provider will be to promote, when it's government, the government usually have two broad objectives: promote employment and or exports. Those are the usual objectives that government have in mind when they decide that they're going to give a grant to particular people. What we should note here is that this is their objective. Obviously, our objective is to make profits. Their objective is to increase the number of employees, so the number of people in the economy who have a job, and to increase the activity that's taken place outside of the country, so the exports that are occurring. Because they have these objectives, they will usually have conditions attached to the grant. So, for example, when Dublin Business School came to Malaysia first, or it was in the early stages of their coming to Malaysia, they received a grant from the Irish government to encourage them to market their business internationally. So the government's objective there was to generate exports. And a condition there would have been, a standard condition from the Irish government in that circumstance is, if you don't achieve a certain level of exports, a certain level of export sales, you have to pay the money back. So you are encouraged to use it for the intention that the government who are providing the grant have in place. So two principles here, two of the fundamental principles are applied, a combination of prudence and accruals. Now, generally, we see that the accruals concept takes preference over accruals in modern financial reporting. So, what will normally happen here, and a common approach, is say the government pays say 40%. So the government will say, okay, we want to encourage, let's say, staff training. So we will give a grant of, if a company engages in staff training, we will pay 40% of the cost of the training. So we're trying to improve the quality of the workforce, the skills of the workforce. And sometimes government might say these are the particular courses they must go on. Other times they'll just say, listen, go on any course you like. We assume that companies, serious businesses, are going to choose courses that are appropriate for their business. And they're still going to have to pay 60%. And once they demonstrate that they have paid, then they'll be able to claim 40% from the government. So what this implies here, and the reason that we have these two concepts in place, is that firstly, the company pays first, and then it claims the grant later. And what that can give rise to is possible timing issues. So the government have told us that they're going to give us the money, so great. we can use that to reduce our expense, and encourages us to engage in the activity, but we must match up the cost and the revenue, provided that we're confident we're going to get the money from the government. We're going to satisfy the requirements. So the grants fall into two broad categories. The first are revenue grants. So revenue grants, these are used to offset direct expenses. So, for example here, the government might give grants for directly against wages and salaries, marketing, staff training, etc. The other big one that government often support and provide research, grants for is research. So if we engage in direct expenditure, then the government will pay us some contribution towards that, and therefore we can use that to cover the cost of the item, or to reduce the cost, the burden to the company. So the grant, the approach here using the accruals concept is we will, to the greatest extent possible, match the grant, the income that we're receiving from the government against the expenditure. So it may be in year one we pay $10,000 on marketing, and the government is going to pay us 40%, but we don't actually receive the money until year two, because we need to submit a claim to the government. They need to approve the expenditure then and make the payment. If that's the case, then they will receive. We will make an accrual at the year end to recognize the fact that the money is due to be received. So, principle of matching. As always, you match costs and related revenue. So the revenue is incurred this year. The grant is going to come in next year. We're going to offset those two against one another. Now, this is unusual. So there are two approaches allowed. A general presentation of revenue grants. There is a general principle in financial reporting. Or of accounting standards, is that there should be no offsetting. However, IAS 20 allows offsetting. So it allows two different approaches. So we should just recognize that this is an unusual standard for that particular approach. So there are two approaches. Anytime there are two approaches, it is usually bad news to allow choice, and accounting standards avoid that. So we have either credit the income statement. So we have an expense, which is the debit in the income statement, and income, which is a credit in the income statement. So we show the expense and the related revenue separately, or we just offset. So the key here is there is a choice. Generally speaking, this is unusual. So we normally considered so a choice is usually considered bad because it reduces the comparability of financial statements. So you are a shareholder, you have invested in two companies. There is Cormac, Cormac's Tire Shop and Richard's Tire Shop. So both of them are in the same business and you want to be able to compare them. But the accounting standards allow the companies to adopt different accounting treatments for exactly the same item. So that reduces comparability. But it's allowed in this standard, so just recognize this. So choice reduces comparability. We're not able to compare the performance of company X, who received a substantial grant, with company Y, who did not receive the grant. The other category of grant is a capital grant. So the same logic applies. The only difference here really is that the benefit is going to be spread over a long period of time. So this is assistance to buy an asset. So exactly the same rationale. The government wishes us to engage in research to develop better processes and systems in our business. They realize that it's, let's say at the moment, Malaysian government decides it wants everybody to, or its industry to upgrade to the Internet of Things, the latest manufacturing 4.0 Internet of Things investment, but they realize that companies don't have the capital available or are reluctant to invest the capital that is necessary. So the government says, okay, we will buy some of those assets effectively, exactly the same, we'll pay 40% of the cost. The treatment of that, so there's money coming in to the business. Once again, we get a choice. So there's a choice available. We can either deduct the grant from the cost of the asset, which will lead to reduced cost figure on the balance sheet and therefore the reduced depreciation. Or we'll have a separate asset, a separate item. It's not an asset, it's actually effectively a liability. We will recognize the grant as a separate item. So I bought a new machine for research. It cost 100,000 ringgits, and the government gave me a grant of 40,000. So depreciation is over 5 years. So I have an asset of 100,000 less depreciation, 20,000 per year. That's the asset. Then on the liability side of the balance sheet, I have this strange liability, which is deferred income of 40,000 because the government gave me 40%, and I will transfer that 40,000 to the profit and loss account over the life of the asset. So this is the bit here, we're going to transfer a portion to the income statement. This is, we're going to amortize over the life of the asset. So we're going to have depreciation and amortization. Both methods are allowed. The choice, the bit here where the grant less the where the grant and the asset are shown separately, gives rise to this very strange credit balance on the liability side of the balance sheet, because it suggests that we have this real liability there, but in reality, the government just gave us money. So we should note here that both treatments are equally acceptable and capable of giving a true and fair view or fair presentation. So this accounting standard is unusual in that it allows a choice as to which method we want to adopt. So we've got a fairly straightforward example here. In this particular case, we just highlight some of the key issues here. It's a new factory, and the government grant is 15,000 in respect of equipment which cost 100,000. The plant, it depreciates the plant and machinery at 20% straight line. Okay, so we can show the financial position extracts in respect of the first year under both methods. Okay, so let's see what's taking place here. The first approach that they're adopting is deduct from the asset. So you have the deduction from the asset is, if we start by looking at the balance sheet, statement of financial position, we see we have the asset value here is the original 100,000 cost minus 15. So we have plant and machinery is recorded at cost under non-current assets at 85,000. That's depreciated at 20% per annum for the next 5 years. So that gives rise to a charge of 17,000, and that becomes an expense, depreciation expense in the income statement. And that will continue then every year for the next 5 years. We will accumulate the expense on the income statement. Accumulate the expense each year on the income statement until the asset is fully depreciated. So that's the first method. That's possibly the easiest method. Method 2 is where we create deferred income. So what we, on our balance sheet, if we look at the balance sheet to start off with, we have our asset is now at a cost of 100,000. So we have an asset on our balance sheet, 100,000. We have a liability on the opposite side of the balance sheet, which is this deferred income, which starts off at 15,000. That's the amount of cash received. So that's the grant we actually received. Then we're going to depreciate the asset, 20,000. So every year we're going to have the depreciation transferred from the, obviously that's a deduction. So it's going to be transferred from the balance sheet to the income statement as an expense. But we also have every year, we're going to have the amortization of the grant. Similarly, every year for the life of the asset, in this particular case, is going to be 3,000. What we see is that on the income statement, the net expense is still 17,000. So we have to ask ourselves, well, why would we bother with all of that carry on? Well, it's argued that the second approach, this approach we're looking at here now, with the asset and the grant showed separately, gives better information, because now I can compare Cormac's tire shop with Richard's tire shop. They both have investment exactly the same. And then I see on the liability side of the balance sheet where Cormac has received a grant and Richard has not. Whereas under the previous method, it looks like Cormac was able to buy his machinery for 85,000, whereas Richard was only able to identify the same machinery for 100,000. So Richard is not very good at negotiating to buy machinery, it would appear. Now, so in terms of giving further information, method 2 gives more information, but it has this very strange liability. It says the government grant here is a liability, but it's not a liability at all, or it's usually not a liability. So we'll note here the problem with the deferred income does not meet the definition of a liability. So that's the concern with the use of the second method, that the statement of principles tells us a very important definition of how we identify a liability. The key here is that for a liability to exist, there needs to be a probable outflow of economic benefit, and that's not the case. Under normal circumstances, the grant will not be repaid. If we expected it to be repaid, it would be a loan. It wouldn't be a grant. So it is not probable. So that's where the problem exists. The standard still allows it, so we just need to recognize that there is a problem with this accounting standard in that it allows a treatment that is not strictly in line with the statement of principles. Also, it doesn't satisfy the requirements for a contingent liability. So it hasn't satisfied those requirements. So there's a conflict there. The standard allows this conflict to arise and exist, and we just need to recognize that. The reason here that the contingent liability definition is not satisfied is the uncertainty should not be within the control of the entity. So if the condition, for example, is that I need to increase the number of employees, well, just go and hire more employees. I can satisfy that condition. Yeah. So that is wholly within the control of the entity. Therefore, it's not an uncertainty. Therefore, it doesn't meet the definition of a contingent liability. So what's most important about this standard from your point of view is to understand the treatment, to how items are recorded in the financial statements. A more advanced point is the fact that the standard allows choice, and choice can be bad news. So it reduces the comparability, and also that there is a conflict with the framework. Yeah? So just recognize here that this is a point for discussion amongst accountants, is that the framework document contains this conflict. Okay, we'll come on in a little while and look at a question that is related to government grants. However, before we take our break and look at a question, I want to look at borrowing costs. So this was quite an important accounting standard, which clarified a treatment that had been under debate for a long time. So what the standard now tells us is the qualifying borrowing costs. So basically, we're looking at the interest cost on a qualifying asset must be capitalized. No choice. So compare this with the previous standard. This is what's normal. The accounting standards do not like giving choice. Yeah. So there is no choice here. If it's a qualifying asset and you have finance costs, you must capitalize them. You must include them. So what do we mean by qualifying asset then? So a qualifying asset basically takes a substantial period of time to be ready for its intended use. So the classic here is, well, look at the campus in KPTM, where they're building the library, the new library and the new lecture halls. So it takes a period of time. If you think of it, for a company needing a new factory, they're going to have to identify a site for the factory. Then they need to apply to DBKL or whoever the authority is to get permission to build on that site. They need to get an architect and an engineer and all of those different people. And then they begin construction. So they pay a lot of money today, 1 million ringgits, to buy the land. Then it's going to take 6 months of architects and putting in applications to government before we have permission. So I'm paying interest on that 100,000. Then I'm paying interest on the 1 million ringgits I use to buy the land. Then I start construction. That costs me another 2 million, and I have to pay for that. Construction takes a year, so now I'm 1.5 years where I have incurred interest right throughout the period. And what the accounting standard tells us is that interest cost is an extra investment in building your own asset and creating your own asset. So if the next point then is, so the first principle is we must capitalize the finance cost. The next is, okay, how do we identify exactly what we're going to capitalize? So if we borrowed funds specifically for the project, so if we can identify the monies we borrowed. So I borrowed 1 million ringgits, I bought a piece of land, then I borrowed so I have a loan there which cost me 60,000 ringgits, and then I borrowed a separate loan for 2 million for construction. That loan cost me interest of 85,000 ringgits to pay it off. Then I would capitalize that exact cost. So where possible, actual interest cost so the actual interest cost if possible. If we can't identify it, so if basically I had a pool of capital which I'm using for a whole lot of different investment decisions, this is the norm. Well, if that's not available, so I don't have, so I'm going to use the actual if possible, or if that's not possible, I'm going to use weighted average cost of capital. So we're familiar with calculating weighted average cost of capital in finance. It's exactly the same approach. We're going to look at a question in a little while where we're going to have to calculate exactly that, the weighted average cost of capital. So one part of the question then is identifying what is the finance, the rate of return that we're going to use in order to calculate the figure to be capitalized. A separate point here is we should note is the amount should not exceed the actual borrowing cost incurred. So if, let's say I have total financing in my business is 5 million from shareholders, there is no immediate finance cost associated with that, plus 1 million from debt. So on my income statement, I'm only going to have interest from debt. So that's going to have a relatively low cost. I can't capitalize more than the actual cost on the income statement. So the lowest my interest expense is going to be is 0. The next then is, when should we engage in this capitalization? So the term used was that we should be in the process, we should be constructing the asset, preparing the asset for use. So the key here is that there's active preparation is taking place. So think about KPTM and the library. That library has been in construction for a number of years. For the last year, I'm sure that nothing has taken place because of COVID. Well, then the company is not preparing the asset for use for the last couple of years. However, there was a period of time when construction was ongoing. That is the period when we can capitalize interest. So we're going to need to identify this time carefully. So the conditions are then, to satisfy this, is that we're actually incurring expenditure. Well, if we have, the architects drawing up plans, that is a period of time when we're preparing that asset for use and we're submitting applications. That would qualify. Then the builders arrive and they start construction. So expenditure is being incurred. We also need a period when we're actually incurring borrowing costs. We have borrowings necessary. So if in the case of KPTM, the piece of land, they didn't need to buy it. They already own that piece of land. Even though it took 6 months before they could start construction, they can't capitalize during the first 6 months because the asset, they didn't have to borrow to buy that asset. And then the activities are in progress. So this is key. The key thing to think about is if you think about the library and then you can apply that to all other circumstances, the company has to be actively engaged in preparing the asset for its use. So let's say our library, we bought the building 5 years ago, and it's still not complete. However, the period of active construction is only 1.5 years. So there's 3.5 years where the building has been sitting empty. Well, you're not allowed to capitalize during that period. So the second part there of the notes go on to tell us capitalization should be suspended. That means the alternative is treat interest as an expense in the income statement. That's the alternative. So it should be suspended when work has been interrupted, So construction is interrupted or suspended, and it should cease when the activities are complete, necessary for use or sale are complete. So the library is finished today, but we don't actually open it until a year and a half. And it's ready to, we're going to actually use it then. The key point date is today. It is ready for use. The fact that the board of directors decide to leave it sitting there without using it, then that's a different decision, but they're not going to be able to capitalize interest in those circumstances. So as an example here, the company here is beginning to construct a supermarket. So if we think about let's see what's on the 1st of January X5, company X began to construct a supermarket which had an estimated useful life of 40 years. Okay, let's look at the timeline here for a moment. What we're concerned about here is the period of construction. So we're looking at the period during which construction is ongoing. We don't care about the 40 years. That's when depreciation will take place. Yeah? We're looking at what interest should be capitalized during this period. So it purchased the leasehold interest in the site for 25 million, construction costs of 9 million, and fixtures and fittings of 6 million. The construction was completed. So during this period, then we take this period and we expand it. We say that starts from the 1st of January let's go back here. 1st of January 2000 X5, and it was brought into use on the 1st of January 2000 X6. So this is when the asset is ready for use. So it's only during this period that we're allowed to capitalize. But even within this period, we see that the construction of the supermarket was completed on the 30th of September. So if we take this period, we see here on the 30th of September, so we have our first period from the 1st of January to the 30th of September. Construction is ongoing. So by this point in time, the asset is fully constructed. Therefore, this is the only period only capitalize 9 months interest. Even though the loan, we were told, the loan was was the company borrowed 40 million on the 1st of January and repaid it 2005 and repaid it on the 30th of June X6. So the loan was for a year and a half, but we're only allowed to capitalize for 9 months because that's the period during which construction was ongoing. So that's what we see here. We have capitalized interest at 10%. This adds on to the cost of our asset, and then we will depreciate that asset as normal in future once we start using the asset. The advantages and disadvantages of this approach. The arguments in favor, this is basically a commercial reality says that borrowing costs are part of the total cost of the asset. The company has a choice to make. I can build the asset myself, or I can go and buy it in the market. If I buy in the market, then I'm going to have to, or the builder will have included in their total cost the interest cost. So if I build it myself, I should,
the screen is not on.
Screen is not on, okay, sorry there. Don't know what happened there. Okay, for some reason it's causing some problems here. Give me a second, please. Okay, screen back on. Sorry about that, guys. Yeah, we're almost finished the notes here now anyway, and we'll take a quick break. So the first argument is, as far as I'm concerned, the arguments in favor of this treatment are very strong, very good commercial reasons. So borrowing costs are part of the total costs we're going to incur. You should, and the board of directors should, consider the cost of finance when they're making the decision to construct a new asset. And it allows us to compare a company who buys an asset fully constructed with a company who decides to construct it themselves. There are problems, however. I think that the problems are not such great problems. But we should recognize that they are problems. So the finance costs may not be direct. So we just use WACC. It's not a very good argument. But fair enough, it's an argument, but not very strong argument. There may still be a lack of comparability. If I am totally equity financed, then my cost will be less than you if you have debt, because you'll be able to capitalize some of your interest. So there's still a lack of comparability. What I would say here, if this is a major issue, then the company should revalue. So we recognize these as arguments against, but they're not very good arguments against. There's the good, strong commercial arguments to support the capitalization of interest. Disclosure, not a big fan of disclosure requirements, so we're not going to spend any time on those. In the real world, what happens with disclosures is at the end of the audit, you will get you'll download a disclosure requirement checklist, and you will complete that to make sure that you've satisfied all the disclosure requirements. Okay, let's take a break there for a few minutes. We'll come back then and we have 2 questions to look at. I believe you have these in your notes. So one question specifically on borrowing costs, and the second question is a bit more complicated question on government grants. So that's 5 or 6 minutes there, guys. I'm going to switch off my camera, etc. Let my computer cool down a bit. And then we'll come back and have a look at those questions. Okay, see you in 5 or 6 minutes, guys.